Hello and welcome to our special show, Decoding the Mauritius Tax Treaty. We get you three views here. The pro, represented by RAKESH JHUNJHUNWALA, the converse, represented by SAMIR ARORA, and the official view, represented by Economic Affairs Secretary SHAKTIKANTA. But first, the issue. Since 1983, investments in Indian shares coming from Mauritius did not have to pay capital gains tax in India. But the tax treaty with Mauritius is now all set to be amended. Starting April 2017, Mauritius-based investors will have to pay capital gains tax. First at half the rate, and after 2019, the full capital gains rate as applicable to residents. Earlier today, I and my colleagues Sonia Shenoy and Anuj Singhal spoke with veteran investor RAKESH JHUNJHUNWALA. We began by asking him how the markets ought to approach the change in the tax rules.
I think it's a very sensible move by a sensible government. See, please let us see what they have done. Foreign investors who are coming to Mauritius were not paying any long-term tax, no short-term tax, and on derivatives also there was no tax. Now what they have done is they have ended, and there was a lot of litigation of what will apply to Mauritius and what will not apply to Mauritius. Now all litigation is set to rest because all shares bought before 31st March 2017 through Mauritius route are tax-free. All derivative income is tax-free, all capital gains is tax-free. Now you compare what I pay. I pay no long-term capital gains, I pay 15% short-term capital gains, and I pay 34.2% rate of tax on my derivative income. Now what has the government done? All past litigation is over. Up to 31st March 2017, everything is exempt. Beyond that, they will pay only 17% on derivatives and 7.5% on long-term capital, on short-term capital gains, and no long-term capital gains. And they have set out a clear picture up to 31st March 2019. What's going to happen post 2019, nobody knows. We don't know what government is going to be in power, what the policies are going to be, right? So I think this is a very sensible act by a sensible government, and I don't see any case for a short-term reaction, because as it is up to 31st March 2017, nothing applies. The status quo it remains, and all past litigation is put to rest. So I think it's an extremely sensible move on part of the government. And as part of the OECD movement also, now governments want to block, tax exemptions due to tax-free havens. Maybe government. So I think it's extremely sensible, well thought of, and very well in the sense there is no case for immediate reaction. And I think what they have done is, if FIs don't want to invest in India, it's their choice. But if you pay 7.5% tax and 17.5% on the derivatives also, they will have to pay still 7.5% on derivatives. I think is very reasonable. So I don't see any case for any kind of a fall. And 31st March 2017, nothing applies. After that, you have to pay 7.5% on your derivative income and 7.5% on your short-term capital gains. I think it's very reasonable, very sensible. Litigation is ended. There is no case for immediate reaction. And also, a lot of the FIs, 70% of the FIs are paying tax in their own countries. So I think this kind of a blackmail, where if you change anything, the tax laws will hit the market, I think it's not going to prevail. It's not going to stay.
But Rakesh, that said, there is the fact that $33 billion or more than 25% of the money comes through participatory notes. And that product dies, according to experts, because that can survive.
No, it doesn't. No, I don't agree. Okay. No, it doesn't. I don't agree. It does not. The product does not die, because the reason why the participatory notes is not only because of the tax benefit. The problem of the participatory notes is that there are people who cannot get registered with SEBI. Or suppose I'm a large investor investing 5 billion, and I want to invest 50 million in India. So I don't want to go through the whole process of having a SEBI registration. So I don't agree that participatory notes are only there to hide the beneficiary or to take tax benefits.
No, I'm not saying that the product existed because of people wanting to escape tax. The explanation we got was that it is first in, first tax. The product itself does not recognize the man who is buying, but the broker. So a sale by a second investor could be taxed because somebody else bought it first. I mean, the point is That product can
I
survive
don't-
only in a non-tax regime.
But sir, I don't know who your tax experts are. The change in the law has been made for sale of shares of a resident Indian company. Remember, the company which issues the P-notes is not in India. It's not a resident company. The company which is issuing this law applies to sale of shares of a company resident in India. Now, the P-note is issued not by a company which is resident in India, but a company which is resident abroad. So this law does not apply to them at all. So this is all hogwash that the P-notes will be taxed 2 times.
Other big talking point is that in 1 year, will we have a long-term capital gains structure as well in place? It looks like this, this government is on its path to take that kind of reform as well. Maybe increase the long-term capital gains horizon from 1 year to 3 years, or tax long-term gains altogether. Would that be a negative, or should the market take it in its right?
No, I'll tell you one thing. Nowhere in the world is there a STT and a long-term capital gains tax. If government is to impose a STT, they will impose a long-term capital gains tax, they will abolish STT. We can go on speculating about anything. Nowhere in the world do you pay a long-term capital gains tax and a STT. And the government collects 7,000-8,000 crores of revenue just from 2 exchanges. So I see no case for a long-term capital gains tax along with STT. You abolish STT and you have a long-term capital gains tax. And anyway, whatever is going to happen in the future is going to be negative. And suppose, so I don't think they're going to impose a long-term capital gain tax.
Okay. Rakesh, also, there is this other amendment that the finance minister came up with, that from April 2017 to March 2019, the benefit of the 50% reduction in the tax rate applicable in India will be subject only to the limitation of benefits article. So you have to be a bona fide business located in Mauritius to avail of that 50% rate. Do you foresee some sort of litigation because of this?
No, ma'am, there is no litigation. They have said clearly that if you spend 15 lakh Indian rupees on a company in Mauritius, right, you are going to get the tax exemption. If you place one person there to look after a company, he's going to cost you more than 15 lakhs. In fact, they have taken away the source of all litigation. And they have quantified that on what basis you will be able to get the benefit.
Okay.
So what is very, very good is, see, people don't mind paying some tax. What they don't like is litigation and uncertainty.
Okay.
So the scope for litigation and uncertainty has diminished substantially.
No, Rakesh, the other point that I wanted to ask was that, do you see the Indian market outperformance? Of course, this year we haven't really outperformed, but do you see the Indian market outperformance continuing if we have, this Mauritius issue as a reality and GAR as a reality, purely because of the kind of domestic cues that we have? Do you think this is something that the market will take in its stride and move on? You have been bullish on the market. I heard your last interview.
Let me tell you one thing, that GAR is not something which is unique to India. It's prevalent over the world. And I have not seen a bull market in which people don't participate if there is a 20% rate of tax. So I see no reason why money will come into India. First think of the income, then because of the tax. If I see income, money will come here. This is all hogwash, that because of a 7.5% rate of tax, people won't play, foreigners. I pay 34% on derivatives. Today for them it is tax-free. Post 2017 they'll pay 7.5%. So I am playing after paying 34%.
So
and I don't withdraw, and they'll withdraw because they have to pay 7.5%. What kind of an argument?
No, Rakesh, our argument is not...
No, it is just, you want to treat the foreign investors as your son-in-laws for no reason. I think government has done something very reasonable and very right. And hogwash, that sale of shares of a resident Indian company, 2 companies will be taxed, and P-notes will not be issued. You see, there will be more P-notes 1 year later.
The P-note was not because people wanted to escape tax. What we were told is that the P-note product is designed in such a way that if you impose capital gains, then that product cannot survive because of the first-in, first tax.
Why it will not survive? Some tax, see, there can be 2 views, but madam, this capital gain applies to sale of shares of a company resident in India. When the P-note issuer gives the money to the P-note buyer, he's not selling shares of an Indian company. He's selling shares of that person is selling shares of a Singaporean or Mauritian or British company and then pay. So you don't have to pay Indian taxes. You have to pay Indian taxes on sale of shares of a company resident in India.
Okay.
The P-note issuer is not resident in India.
Okay.
Okay, what about another point that we got, that there will not be any knee-jerk reaction in the market, but because people don't want to, are not able to come through the P-note route, some of the futures market may actually migrate to SGX, to Singapore. Do you see a migration of volumes?
Ma'am, it may migrate, some of the volumes may migrate, but I think 7.5% rate of tax is a reasonable rate of tax.
Okay.
If some volume migrates, so be it. Yeah? We are not some African country, we can't do without them. If they feel their capitalist potential in India, they will come. They are not going to not come just because of 7.5% rate.
Okay.
That's my opinion.
All right, so that is that. But let's talk a little bit about the markets as well, Rakesh. You know, we have seen green shoots visible as far as earnings are concerned. We're seeing it in the auto, in the cement sales. How have you read into all of that? And do you think that based on this, there could be some more momentum in the market on the upside?
Well, madam, I think we are, as an opinion, we are seeing green shoots in the economy. I think the Indian economy is on the verge of a major reversal. It's being done without, spoiling the fiscal situation or reducing rates on an unwarranted basis. I am bullish. I think we have had a very, very good gain, and we are consolidating. And if monsoons are good and markets internationally are good, I think we will see a good there is a very large up move which is remaining, maybe a bull market the like of which we have not seen as yet.
Okay, Rakesh, I must say that we are on same page as far as this FII taxation is concerned. There should absolutely be no doubt on that. So when you say you are super bullish, do you think that the kind of earnings growth we have, we could have a bigger bull market than the one we had in 2003 to 2008? Now that the market has gone through so much correction over the last 1 year, time-wise, price-wise, valuation-wise.
See, I'll tell you one thing, sir. First of all, how did the bull market in 2003 come? The ratio of corporate profits to GDP was at all-time low. Same thing prevails today, right? The economy came into an upturn. The same thing prevails today. Interest rates were coming down in 2003. Same thing prevails today. And also, I think what will be recognized is there has been a lot of steps to improve efficiency in corporate India. The moment you get volumes, the increase in margins will be far disproportionate to the increase in volumes.
Okay, so that was a very strong bullish view on the Indian economy and an argument that treaty changes imposing capital gains will be taken in their stride by investors simply because this is a performing economy. Now, after the break, we are going to get you an equally strong view from veteran investor Samir Arora, who is questioning the tax changes and says that there is no rationale for these tax changes. And of course, we will also get you the official view of the government of India. All that waiting to come after this break.